Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities. And as you know, we do a lot of work on the valuations of individual stocks in the market itself. And we're getting into that bubble phase for the overall market. It's concerning. So, big red cautionary flags going up here. We've got some good updates on some biotechnology stocks, and there's some good earnings reports that are going to come out this week as well. On the overall market, we talk a lot about the valuation of the market on forward PEs. And doing a forward PE analysis requires getting the earnings done properly. So we just simply take the consensus expectations of earnings. If you go back and you look at the forward PE over the last 30 years, you can see that it only got above 20. See the chart here, above 20 in that bubble period of the late 90s, early 2000s. So this is COVID distortion. The last several years, 2020, 2021, 2022, this was COVID related by and large. So when you look at the PEs of the markets over time, very rarely does it go over 20. So we're at 19.9 times currently. Granted, valuation is not a very good timing mechanism, but if you look at this chart, if you have any sort of time horizon at all, it's a really good timing mechanism, but it takes a little bit of time to work out. You can see that the average multiple on forward over the 30-year period has been roughly 16.6 times, and the bottom has been on average about 13.4, one standard deviation of 13.4 times, and it's been all the way down below 10 at times as well. But keep in mind, 20 times earnings is a very high valuation, and we're getting up there on forward PEs. Now, we also wanted to take out any sort of forecasting issues on earnings, so we also looked at it in terms of trailing 12-month earnings. So if you look at, if you take out the distortions, so you take out the recessions, you take out COVID, and since 2005, you get roughly a PE multiple of 17.9 times. So 17.9 times is the average, 14.9 times is the low, and the high has been 25. We are currently over 25 times. So we have two different services that we use. One's about 24 and change, the other is 26 and change. You average two together, you get over 25 times. So that is above the high end of that range since 2005. So just keep in mind, interest rates have been lower over this period of time as well. So even more of a valuation issue. The interest rate on the 10-year Treasury has been roughly 2.7% since 2005. We're up over 4%. So interest rates greatly impact valuations of equities. You can see here that we are above the high we made in 2022, and so there's a little bit of momentum left in the markets. I think that's what is currently occurring. The technicals of the markets, generally, they're moving in all the right directions. So you have the 200-day, the 100-day, the 50-day, the 20-day, but it's not feeling all that great to us. So there's one indicator that we developed many years ago by doing a lot of regression, in that when the S&P gets above 20% return over a 12-month period, it's a really reliable sell indicator. So we're currently above 20% over the last 12 months. So what's happening with the market, it's getting these wild moves. One day it'll be down very big, really negative internals, much more in terms of declining issues versus advancing, and then it'll shoot back the other direction where you may not have as many advancing issues as declining, but it goes back up. So the market is getting narrow again, It's broken the 20-day a couple times since the beginning of the year. It has broken that old high right around the top of this chart. And so there is some leftover momentum in the overall markets. But we're concerned that the technicals are a little bit too extended. Depends on emotions. So it depends on the emotions that are left in this market, how high this market will go. The economic data. So there are some really smart managers or economists out there that think that we are already in a recession. So we wanted to peel the onion back a little bit to look at what they're looking at. We think that it's possible that we may enter a recession somewhere around the middle of this year. So we don't think we're there, but we could be. We could be in a recession now. So what they're looking at is a couple things. The inverted yield curve. The inverted yield curve has been that way. So the 2-year higher than the 10-year. So that's a really negative sign for the economy historically. We've been that way for roughly 1 year and 7 months. So it's a very long time period to have an inverted yield curve. So that's a 100% indicator that an inverted yield curve for that duration of time, or an inverted yield curve in general, gets you a recession 100% of the time. The ISMs, now this is the ISMs over here. The ISMs are a good read of the manufacturing sector of the economy. When it's below 50, it means the manufacturing sector is declining. Now, there's periods of time here where it goes negative, it goes below 50, but we don't enter a recession. So generally around that low 40 area, when the manufacturing sector is down at that level, you are in a recession. So right now we're above 45, 46, 47. So we have a manufacturing recession, clearly a manufacturing recession, but it hasn't tipped the overall economy into a recession. The leading indicators have been weak for a while. So the number of reports that we've had negative, there's a lot of them. The magnitude of negativity isn't enough to say, okay, we're in a recession. One thing that's bothered us for a long time, and some of these other managers as well, is that the employment reports, they all seem to be faulty. They'll come out with a good report, a big jobs increase, and then the next month they'll knock those numbers down. So they'll revise those numbers down in a big way. So it's time after time, good report, and then they revise it down. Good report, revise it down. We think there's a number of distortions in the employment report. If you take out the distortions, instead of being 3.7% unemployment, you're up over 4%. The unemployment report follows very closely recession. So when the unemployment starts to go back up, that's when you have higher degree of confidence that we are in a recession. So that may be an indicator that we may be going into a recession, or maybe the recession is already occurring. But because of those distortion, it's hard to really tell. On Friday, we get the PCE prices. So this is something that the Fed likes to look at. PCE prices are expected to be up about 2.5% year over year. So that's moderated quite a bit. It got up to 5.5% over the last 12 months. We think it's on its way back down to maybe 2%. So the PCE prices takes out the volatile food and energy. That's why the Fed likes to look at it. We think the report will probably be somewhere around consensus, up 2.5% and up 0.2% month over month. We're not concerned about inflation. We would be concerned about inflation if the Fed got really aggressive on cutting rates. We think that reinvigorates the cycle of inflation again. Earnings reports. So lots of earnings reports coming out this week. The major theme of the market's been artificial intelligence and obesity. The tech group has been leading the market now. It started out very weak, but it's now leading the market, followed by the drug sector. So the drug sector is going to benefit for multiple years from the obesity drugs that are are hitting the market and that will hit the market. So this will be a very big area for drug development going forward. On Tuesday, there's a number of really good companies that we've been looking at: 3M, Halliburton, J&J, Procter & Gamble, Netflix, Texas Instruments reporting. So, if there's an opportunity here, if one of these stocks trades off on some bad information that's not really critical, we will probably step in and buy some of these stocks. Elon Musk's company Tesla reports on Wednesday. We don't expect any good news from this. We think the EVs have kind of are played out in the short term anyway. The 73 cents is expected for Tesla versus $1.19. You can see the pressure on their earnings. So we'll see if they what the earnings will look like, and maybe it'll be better expected or worse expected. We don't have a good feel for it, except that it'll likely be significantly below what they reported last year. Intel reports on Thursday. This is a barometer for the semiconductor sector, which has been very weak. We're looking for Intel to report on Thursday. This will be a good barometer for the semiconductor sector, which has been very strong of late. Now, the small cap biotech. So obviously, this is an area that I really like. There's a lot of money to be made in this sector. We got into FBIO. I guess should say we got into it again at some of our portfolios at around $1.35 at the end of last year, and towards the end of last year, and the stock ran to $3.80. The stock is back down below $2. Called the CEO of the company today just to get an update, and he's buying back stock. This has been reported. He's buying back more stock recently. The company has a lot of cash. That's really important for biotechnology companies. So the cash probably equals or is greater than the market cap of the company. And then they own a company with ticker symbol DERM. Journey Medical is the name of the company. It's got a nice chart. Has been moving up. They own roughly 50% of DERM. That equals about 50 million. The market cap of FBIO is about 40 million. 50 million is coming from one position that they own, plus the cash. Plus, there's some really interesting catalysts coming this year. We think the stock should be a minimum right now of $4 a share. So there's 100% upside in that particular name. We did a call with Viking Therapeutics last week. It was a great update. Really quickly, their oral obesity drug, they'll have data this quarter, so in not too long they'll have data on that drug. On the phase 2 injectable, they'll have data sometime likely in the second quarter of the year, and also have data on their NASH drug that we think is probably the best NASH drug out there. And there is a catalyst from another company that will likely get approval in NASH that has something similar but not as good around the March timeframe. So lots of catalysts for Viking. We think they have probably the best drugs in that obesity space and in NASH. So we think there's 5x upside in Viking at this point. But the stock's moved quite a bit. We have some cost basis around $2.40 a share, so it's up tenfold since we bought it. And we see some of the directors starting to sell a little bit of stock. So maybe the acquisition of Viking or the sale of Viking is maybe further out than kind of what we thought, but it could be an event that happens this year. Checkpoint Therapeutics. Obviously, you follow our work. We've been in Checkpoint for a while, in and out of it a little bit here and there. We think highly likely that this drug gets approved, and getting a little more information on what's going on there. It was a record-keeping issue at Samsung. Samsung is the largest manufacturer of drugs in the world. So Checkpoint's drug did not get approved, so they had a correction to make. We think that correction is being made. The FDA had no issue with the labeling of the drug. So this company has big upside potential to it. Their oncology drug has big potential. We think it's a big winner over time. So just to repeat a little bit, our view of the markets is very cautionary, big red light shining on the markets, in our opinion at this point, due to valuations. Valuations are not a good timing mechanism. The technicals are positive, however, the technicals are very stretched. We think we might be in the final phases of this market move, and then a major correction to happen sometime later this year. So, our approach of loss-averse investing should hold up really well in this environment, maybe even make some money in this environment as well. The opportunity is to the downside, in our opinion. However, there's certain areas of the market that still look interesting to us. So please hit like, subscribe, come to my website, sign up for a hard copy of Market in a Minute, and we'll send that to you every week. Just keep in mind, there's more detail on the hard copy than what we cover in these videos. Take care.